not. It's not showing me. All right. All right. Let's play one of my favorite songs before we start.
Pain and guilt I felt from the things I've done. Win some, lose some. Can't switch sides, gotta choose one. All my niggas free, all our problems gone. Too blessed to be stressed, yeah, yeah, yeah. 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 Told you I would do it big, told me that it couldn't be done. Told me I should hang it up, now I'm on another run. Told me I should do it for the love and that it should be fun. Did it more than once, haven't seen my bed in months. I crush everything I touch, know the city, every cut, but it's never enough. Used to get all the love, don't turn on me just because I'm moving a little different than I was. Head down, looking at it, sales, it was drugs. They ain't want me to win the game, put it on difficult. Buy the shit in bulk, get it sold. One night a nigga role model get rolled up. Somebody rich, somebody getting chose. Where I'm from, niggas real proud to get old. We done seen some things, we been here before. We live in the movies, credits roll. Pain and guilt I felt from the things I've done.
digital age.
Now, obviously, you're probably saying, well, Michael, I only did 2 minis. I can only afford to do that. How can I take this many?
Thinking about a degree in cybersecurity? Don't sleep on this. UMGC is waiving their application fee through June 1st, so now's the time to apply. Low-cost tuition, 100% online classes, and you can gain the skills
Portions off. You can't. But if you look at it again, study it, not all these conditions can be present. But you want to look for the ones that may potentially be there for you. You can go through this list and look at your trade as you get ready to take it and see right away if any of these are going to be potential candidates. But you have to take profits on these rules. That's how I do it. This is the reason why I do it. And when you see me taking positions and scaling them off, this is the criteria I'm using. When do I look to short day trades? Ideally in seasonal bearish periods of the year, but it's not required. When the current quarter or new quarter is expected bearish, after the daily chart has reacted positively on a premium PD array, when price has a clear unobstructed path to an opposing discount array. The ideal days of the week shorting are Monday, Tuesday, and Wednesday. Refer to the central bank dealers range and determine if it's less than 40 pips ideally. Demand the Asian range to be in a 20 pip range or less ahead of the Frankfurt opening. That's basically 1 o'clock in the morning New York time. It's early London. Shorting between 2 a.m. and 4 a.m. New York time, seeking the high of the day. Generally, I'm looking to sell 1 to 2 standard deviations of the central bank dealers range and or Asian range coupled with a premium PD array. Time frame to execute on is either 5 or 15 minutes. 2-minute time frame. Where do I look to short day trades? I like to run above the Asian range, at least 5 pips above it. I want to be selling short there. A fair value gap above a short-term high from the previous day's New York session. There's going to be buy stops above that. I'll look to sell that as it rallies above that in the New York session.
Most traders never pass their prop firm evaluation, and the ones who do usually blow the account right after. Let me show.
Bearish order block above a short-term high, either previous day or today. In other words, if there's a bearish order block that resides in price action, and there's a short-term high just below that we haven't rated yet, as soon as we trade above that short-term high and into that bearish order block, if it does that during London session, I'll go short there. If I'm very bearish, 1 standard deviation with any premium PD array in the London open kill zone, I can trade on that. Inside the protraction, higher post 12 a.m. midnight New York time to 2 a.m. New York time with a PD array or a premium PD array specifically, that's enough for me. So basically I'm looking at a Judas swing that occurs right from midnight going up into 2 a.m. It can happen prior to 2 a.m. but generally you want to see that move right after 12 a.m. up. It trades into a premium PD array. That's enough to get short. Filling a liquidity void that completes above a short-term high. If after the drop post 12 a.m. I'm going to sell the first retracement into a 15 or 5-minute bearish order block. 1 to 2 standard deviations in the Asian range coupled with a premium PD array, I can sell that. And if short-term high is taken out twice with no initial downside, I'll sell that as a turtle soup. Placing stop losses in short day trades. Placing stop losses in short day trades. Whenever you use the sell that as a turtle soup. Placing stop losses in short day trades. Whenever you use the initial stop loss, obviously don't be in a rush to move that. We've said that in the buy side. It's the same thing here for shorting. If you're trading the central bank dealer's range overlap with a PDA, stop must be 30 pips above your entry. If you're trading a run above the Asian range high, the stop has to be 40 pips. If you're trading any buy stop raid, your stop has to be 30 pips above the high or your entry. If you're trading the first retracement into a bearish order block, your stop has to be 10 pips above the highest high of the day.
More money in your pockets, safer communities here in Wisconsin, and government that works for working people. Check out my website to learn more about what we're doing for you in Washington. Paid for by official funds authorized by the House of Representatives.
Check this out. I'm going to show you how I afforded this car. Okay, you ready? All right, $118 for car insurance.
Alright, I'm sick and tired. Man, I fucking hate ads.
If you're trading the second return for buy stops, or basically a turtle soup, and we have not seen an immediate rally lower in price after midnight, your stop has to be 30 pips above the highest high of the day. If you're trading any other setup not described above, use 50% of the average daily range of the last 5 days added to the Asian range high. Taking profits in short day trades.
Daily overlap is PDA. Stop is 30 pips above. If you are trading a run above the Asian range, stop is 40 pips above. If you are trading any buy stop rate 30 pips above the highest last entry. trading the first retrenchment into
taking profits in short day trades. Always try to take something off and gain at 20 to 30 pips, always. Look to scale something off every 2 standard deviations in the Asian range or central bank dealers range. Take something off at the previous day's low, minus 5 to 15 pips. Take something off at the 50% range or equilibrium of the price range you are trading inside of on a 60-minute chart. Take or have taken 60 to 80% off at the average daily range of the last 5 days. Do this always. If trading lower than the previous trading week's low, take something off there. You could have a reversal or rejection. If trading lower than the previous month's low, again, this could be a potential reversal, so you want to take something off there. In time of day, scale out something at or prior to 5 a.m. New York time. In time of day, scale out a short-term low prior to 7 a.m. New York Open. In other words, New York Open could be a reversal or generally a retracement into the 820 CME opening. So you want to be seeing profit taking, some measure of portion come off as profit as it's accelerating lower ahead of 7 a.m. In time of day, scale out at 10 a.m. to 11 a.m. New York time while price is still declining. Ideally, any of the above scenarios coupled with a premium PD array. Now, obviously, I've given you several instances and circumstances and outlines for the probable plan of action, whether you're entering, whether you're taking profit, where you're using your stop at. These are my general rules of operation. This is what I generally look for. These are the things I do, how I manage the position, what I'm doing initially with the stops, where I'm looking to take profits at. The ones that I did not incorporate here were obviously been taught in other places, so I didn't have to rehash or put in filler. Any projection on the fib, 127, 168, and the 100% symmetrical price swing or 100% move, measured move, those ideas coupled with any of these as well really amplifies for profit taking.
Saving money feels right, just like when things are packed tidy and tight.
This lesson, obviously, I don't want to see it on YouTube, and if it ends up on YouTube, I'll have it pulled down. But the lesson itself, I could pretty much show this on baby pips, and nobody would understand what it's talking about. So that's the reason why I went through a great deal of information in January and all the way up to now, because you know all the elements that's being described here, or you should know them because you've studied all the previous months. The criteria and the rules of engagement that's being explained and outlined for both sides of buying and selling, not every single one of these are going to be usable. You can't use every single one of them. They're not going to be applicable to every trade that you're in. So don't think because there's a laundry list of things and scenarios here, not all of them are going to be able to be applied to your trade. But knowing what they are in advance in outline form here, you can already see how you can look to see if it's going to be a probable scenario for your particular trade idea. You may not be trading anywhere near a weekly low. You may not be trading anywhere near a monthly low. So they may not even be any consideration at all. You probably already took something off at 20 to 30 pips, and it hasn't much moved beyond that going into 5 a.m. New York time. So you wouldn't consider that either. The scaling out ahead of 7 a.m. Maybe you have taken 20 or 30 pips already in London, and then it went, the whole full average daily range all during London. You're not going to take something ahead of 7 a.m. on that because you've already taken something based on average daily range being fulfilled. Looking at the scenarios that would potentially pan out here, and also for the entries, again, not all of them will be applicable. So don't freak out because it seems like a whole lot. And yes, if you're being challenged, I promised you in the latter lessons, you're going to have to think. You have to think for yourself. You have to have rules. You have to look for these types of things yourself in the charts. They all won't be there. So you're not having to look through all these things to whittle down to what you should be doing for your trade. All of the criteria that's been listed here for the setups, the buys, the sells, where your stop loss is, there's specific rules for all of that. I have specific outlined scenarios in this teaching that if you stick to them, you'll do everything that I do on a week-by-week basis when I'm trading. So, yes, it requires you to think. Yes, it's a little bit of work. But is it worth it? Absolutely. And until next time, I wish you good luck and good trading. And one more time through. Well, these are %80 off. Try to take, and that one is if periods of the year, okay, from the previous day's New York session. There's going to be buy stop. Short-term high is taken out twice with no initial. Swing or position trades.
How confident are you in turning your vision into value? We help develop a growth and operational strategy that enabled a pharmaceutical company to establish a global footprint. Solutions that work in practice, not just on paper.
What brand am I wearing? Yeah, that one.
American Eagle jean shorts.
Okay, folks, welcome back to Lesson 8, the final of April 2017's content for ICT Day Trading Model. This lesson is going to be teaching integrating day trades with higher time frame trade entries. Okay, folks, we're going to be revisiting Power 3. And we're talking specifically with day trade entries and higher time frame setups. Now we can use day trading entries to position ourselves in our longer term, higher time frame trades. And it's a method that employs very little time and analysis. We do not need to use the London kill zone if you're not able to trade it. Some of you aren't able to get up, aren't able to stay awake, can't do it because of business, family, work. I get it. Trust me, I've been there. We don't need to have the London kill zone to be a day trader. You don't need the London kill zone to be entering with your higher time frame setups as a day trader either. There's a way of using day trading concepts to facilitate an entry on a longer term, higher time frame setups. There are two essential times of the day IPTA refers to reset. The daily candle can point the ideal entries for all styles of trade. And when we look at the daily candle, obviously I've taught this in the past. Power 3 refers to the open, the rally or decline, and then close. Obviously for an up close day or bullish day, we would see the open near the low of the day, a small little wick below the opening price, an expansion move or range expansion, up, then a close that typically closes just a little bit off the high of the day. For a down close or a bearish day, we see the open near the high of the day with a very small little wick above the opening price, then an expansion move lower with the close coming off the low with a small little wick making the low of the day in respect to the close. That's power 3. It's the open, rally, up close, or open, decline, down close. The open is near one extreme of the daily range, and the close is near one end of the daily range. So they're going to be opposite extremes. Now, obviously, it goes without saying, typically, we've mentioned this in many times before in the free stuff, but there is a vacuum of concern when we look at price action like this as a retail trader. We're not even aware these phenomena have any significance. So when we look at price on a daily chart, okay, I just think for a moment, say for instance that you are not able to have any difficulty getting up in London. Okay, just imagine for a moment, if you did, how could you enter as a day trader, or how could you day trade? And you have to avoid the London session. That was one of the things I had to come up with to fill in the void where there was a short period in time where I could not do anything in London. I had to help take care of the kids. My wife was just unable to do anything. She was nursing and healing up from having a child. I wanted to trade, but I couldn't do it because I had to take care of 3 kids, and one of them being a newborn. So I had to really figure out a way to overcome that. And this was my answer or my solution to it. Now, obviously, this isn't the last and be all end all, but for me, it worked. Okay, the open or openings. Now, there's 2 session openings that I monitor daily. It's solution to it. Now, obviously, this isn't the last and be all end all, but for me, it worked. Okay, the open or opening.
fuck do I add that? Control Shift 8. Cap. Okay. That makes sense. Okay. No, it doesn't. What the fuck? These are white circles. How'd I get it? I'm wasting too much time. Okay. That makes sense too. So if that's the case, then I can do this.
openings. Now there's 2 session openings that I monitor daily. It's the 0 GMT. This is your standard platform on Forex LTD demo that you see me teaching with in my tutorials. You can use that time for calibration wherever you are globally. And then obviously everyone knows about the midnight New York time, that opening price as it relates to New York time, whatever that time is on your platform, that opening price on an hourly chart, that's what we're looking for. Well, this teaching, okay, we're going to go a little bit beyond that. And there are very refined entry points that can be had in the London Open. Obviously, that goes without saying. But here's the rub with it. You don't need it. If you understand the daily range and you understand what IPTA is going to do, or most likely to do, let's say it that way, and you understand where you're at in the PD array matrix, where are we moving from? Are we moving from a discount up into a premium, or are we moving from a premium down into a discount? Knowing that gives us directional bias. It gives us an understanding of what we should be looking for, being a buyer or seller. And it's not required to position day trading concepts on higher time frame setups by using the London Open. You're not limited to that. There's other ways of doing it. So I want you to think for a second. Imagine being able to trade the daily range for a single day or hold for a much longer duration of trade, harvesting a larger number of pips. How could you do that? Well, we're going to be looking at IPTA True Day Open, and this is reset. The daily candle at 0 GMT, that's our beginning reference point for IPTA. That's True Day Opening. But then there's True Day, as I refer to it when I'm trading London using the midnight candle in New York. That's my opening price there.
Malcolm, keep playing, see what happens.
How'd you come up with this world?
I've been playing there all my life.
Malcolm, keep playing, see what happens.
With the Reddit IPO, we touched so many different parts of the organization. So directed share program, they were a stock plan client, and then cash management. It really just embodies what the integrated firm can offer them.
Because I'm able to be awake and I'm able to trade London and I'm wanting to be there because I want to be able to capture that really small, tiny little move of protraction up on down days or down moves right before the upper. I want to be able to capture that little movement, or at least get in there and fade that move, so that way I can have a very tight, ultra small stop in relationship to what I may be doing on a higher time frame setup. But when we look at the Power 3, what we're really doing is this: we're looking at the opening price and we're waiting for the opposite to occur in the daily range. When we're bullish, we're going to be buying near the low of the day or near the opening. The million-dollar question is, how much lower from the opening will it go if it's going to be an up close? And if it's going to be a down close, how much higher than the opening will it go before it makes a lower close? I get this question so many times, and I'm just going to tell you this. It's been staring at you all this time. It's been in your charts every day, and you don't pay any attention to it.
Shut the fuck up.
I have also led everybody away from this because it's just one of those things I wasn't willing to share. But because you're in the mentorship, you get to learn it. This little hyphenated little dash that appears on all the daily candles, or not candles, but open, high, low, close bar, if you set that for your platform. That little opening hashtag tick to the left of your daily candles or bars, that opening is all you need to know. That occurs very, very early in the evening in New York time. So I'm on the East Coast. I'm basically the same time as in New York. Residing in Maryland, I have East Coast time. Wherever that is in terms of 0 GMT using the Forex LTD platform, the demo, you need to calibrate your local time and know what that time is where you live. All you need to know is that opening price. That's it. What we're going to do with that information is frame it in such a way where we can use it knowing when we want to be buying or selling. When it's up close, we're trying to capture that big lines portion move up, and when it's a down close, we're trying to capture that big range going lower for a day trade. But this is the same concept. We'll use this in the same vein by trading with higher time frame setups. The key is you have to know where you're at on the higher time frame PD array matrix. Obviously, if we're looking for an up close, we need to be seeing the daily moving away from a discount array. It has to have already respected a discount array. So that way, the next trading day, we should see no movement at all, if very little, below the opening price at 0 GMT. If we are looking at a bear scenario on the daily chart, we have to have recently traded at a premium array, and price has to have shown a respect of that. In other words, it's repelled or failed to go higher. The next trading day at 0 GMT, we're going to be using that opening price to facilitate trade. So let's assume for a moment we have watched our daily chart trade down into a discount PD array. And we're expecting bullish prices now. Institutional order flow has been bullish. We've come down into a level that would be expected to be bullish on a daily time frame. We've hit a bullish order block, and price has shown a willingness to rally away from that. The very next day at 0 GMT, we're going to look at that opening price. Now, I've trained and conditioned all of you to look for that opening price and then expect that down move. That's your classic London setup. But what if you can't be up during that time? The London protraction, you may not be able to see it. You can't be there to watch it. You can't participate, if you will. Well, is that entirely true? Not necessarily. Just because you're not awake doesn't mean you can't take advantage of it. What we look for is, yes, the opening price, but we have already arrived at what? If we were awake at London, we would expect that move down anyway. That's what we're looking for, that Judas swing, that protractionary state in the market where price goes lower to seek liquidity to make a move higher with an up close. All we need to know is, are we more likely to go higher or more likely to go lower? So if we set our daily bias based on the daily PD arrays.
I'm Tom Tiffany, dam tender on the Willow Flowage for 29 years, so I know how to stop the flow of waste and fraud in state government. And since Madison's solution to every problem is to drain your pocketbook, it's time to send in the dam man.
Say hello to Sara Lee Half Loaves. Half loaf, right fit, realize great size, less waste, all taste, more flavors to savor. First bite right. Brand new, all you. Give a little Sara Lee love.
And if the data ranges and the quarterly shift is still bullish, everything that's significantly pointing higher, if we're in a seasonal tendency for bullish prices, if it's a Monday, Tuesday, or Wednesday, it's a loaded deal. The main thing is we have to see price having already respected a daily discount PD array. You have to see it do that, and then the very next trading day, you're looking at the 0 GMT opening price. So that means that in local time in America, that's pretty easy, regardless of where you're at in the North American continent. Real easy to get that price. Where you're at in the world where it makes it difficult for you, I can't answer for that. So you'll have to work in the London session. But for those individuals that want to trade Asia, but have the effects of London open, this is how you do it. We don't know how much of a protractionary state there's going to be. Not always, but we can have a reasonable expectation. So why 0 GMT? Well, you already have central bank dealers range closing right now. At 0 GMT, you know what the central bank dealers range is most likely going to provide you in terms of standard deviations. But what if you don't want to use central bank dealers range? Why? You would think that. I don't know. But let's just say you don't even want to consider it. I think it's an advantage to knowing it, so you can expect how much of a protractionary phase and price will go higher or lower. In this case, going lower below the opening price for a bullish up close during London. But what we're going to be doing is focusing primarily on being a buyer at 0 GMT. Wait a minute. I'm just going to buy it at 0 GMT? Yeah. You're just going to buy it at 0 GMT. You're going to use a 5-day average daily range as your stop. Whoa, Michael, wait a minute. What you're saying is this could potentially be a 90 pip stop. What if it's a 100 pip stop? Then that's what it is. Remember, we're not day trading with minute risk trying to capture 20R. Okay, we're not trying to do that here. This topic and teaching is how to integrate day trading and concepts to get into your higher time frame trade entries. Since you're looking for higher time frame setups, a 90 to 100 pip stop is relatively insignificant because you're looking for moves that are going to be paying several hundred pips, or you should be. That's what you should be looking for, those types of moves. So if you want to frame those ideas, and use day trading concepts, you would be buying at 0 GMT using a 5-day average daily range as your stop loss. You would take whatever that average daily range is, subtract it from the opening price at 0 GMT, there's your stop loss, and you just let it rip. You just trade it accordingly based on your higher time frames until it trades to a premium PD array. Now, what if you want to use this concept as a day trade? You just want to do it as a single one-day event. You think it's going to be a big range. Everything's pointing to a larger up-day close, and it's been small ranges recently, and we respected a discount PD array on the daily chart. Its institutional order flow has been bullish anyway. Its quarterly effect is underway, and it's still bullish. Everything is expected to go higher. It's a Monday or Tuesday or Wednesday. What can we do with that in regards to intraday? Well, you're going to take the same thing and reverse it for sells. We don't know how much of a projectionary state we will have without being awake, so we don't need to know exactly how much that is. We can have central bank dealers range hint at that, but again, we don't know how much of that London projectionary phase in price is going to move up above that 0 GMT. The key is we have already seen price move away from a premium PD array on a daily chart. It has to happen the day before the trade day. So the previous session, we want to see price having respected a premium PD array, and it's not wanting to rally, or obviously hit it and started to sell off. So we're near the high end of the range. It's at a premium. It's already shown a willingness to respect some measure of a premium PD array, some bearish order block, or it's rejected an old high turtle soup. The very next trading day, well, 0 GMT, on Forex Ltd's demo platform, you're going to be looking to sell short right at 0 GMT. Or you can sell at 0 GMT plus 20 pips. And again, using the 5-day average daily range as your stop. What are we accomplishing here? Well, we can anticipate, obviously, a little bit of movement or projectionary phase in the marketplace where the Judas swing occurs right before that down close.
Is your growth strategy a big deal? We helped facilitate the merger and integration of 2 energy companies to fuel a more reliable and affordable delivery model. Solutions that work in practice, not just on paper.
Somewhere beyond the sea.
Adding 20 pips to the 0 GMT opening price, that would be your sell limit order, and then adding the average 5-day range ADR to your limit entry. So let's give an example. Say it was you were getting it in at 1.5000, and the average daily range is at 50. You would get in at 105.00, and your stop would be at 105.50. Now, that's a relatively small stop, but that would be an example. So what you're doing is you're protecting yourself and building in enough of a filter or a barrier, if you will, that the likelihood of price rallying from the open at 0 GMT 70 pips before going down with a down close, highly unlikely, especially if we've seen a previous day or yesterday it trading from a premium PD array from a daily chart. So long and short is, we already know there's going to be very little upside above the opening price because we are in a bearish cycle. So if that's the case, we can just look at the opening price, add 20 pips to it. There's your limit order. Your stop is the 5-day average daily range added to that entry, and then you use your higher time frame objectives for your profit, and you just go to sleep. Just let it go. Now, there's going to be some times you might have a 20 pip limit, and it doesn't go up 20 pips, and it just runs away. How can you accomplish the same thing and not be afraid of missing the move? Well, if you take your total position, okay, and you divide it in half, what was your total lot size that you were going to trade and or percentage risk that you were going to trade at plus 20 pips above 0 GMT's opening? Take half of that risk and just simply add it at the 0 GMT. There's your first portion, put it in there right away at 0 GMT. And then you can do a second portion at 20 pips above the opening price. It may not fill you there, but at least you have something in, so that way with a 5-day average daily range as your stop, there you go. You're positioned. Again, you could just sell at 0 GMT opening and use the last 5 days average daily range as we can. And what are we accomplishing here? Well, we can anticipate, obviously, a little bit of movement or protractionary phase in the marketplace where the Judas swing occurs right before that down close. Adding 20 pips to the 0 GMT opening price, that would be your sell limit order, and then adding the average 5-day range ADR to your limit entry. So let's give an example. Say it was you were getting it in at 1.5000, and the average daily range is at 50. You would get in at 105.00, and your stop would be at 105.50. Now, that's a relatively small stop, but that would be an example. So what you're doing is you're protecting yourself and building in enough of a filter or a barrier, if you will, that the likelihood of price rallying from the open at 0 GMT 70 pips before going down with a down close, highly unlikely, especially if we've seen a previous day or yesterday it trading from a premium PD array from a daily chart. So long and short is, we already know there's going to be very little upside above the opening price because we are in a bearish cycle. So if that's the case, we can just look at the opening price, add 20 pips to it. There's your limit order. Your stop is the 5-day average daily range added to that entry, and then you use your higher time frame objectives for your profit, and you just go to sleep. Just let it go. Now, there's going to be some times you might have a 20 pip limit, and it doesn't go up 20 pips, and it just runs away. How can you accomplish the same thing and not be afraid of missing the move? Well, if you take your total position, okay, and you divide it in half, what was your total lot size that you were going to trade and or percentage risk that you were going to trade at plus 20 pips above 0 GMT's opening? Take half of that risk and just simply add it at the 0 GMT. There's your first portion, put it in there right away at 0 GMT. And then you can do a second portion at 20 pips above the opening price. It may not fill you there, but at least you have something in, so that way with a 5-day average daily range as your stop, there you go. You're positioned. Again, you could just sell at 0 GMT opening and use the last 5 days average daily range as your protective stop. You can take the sell at 0 GMT or add 10 to 20 pips above the opening price for your sell.
Go all in. Buy any 2 Ferrero brands for your chance to win $1 million.
Whenever I'm wearing jean shorts,
I feel free. American Eagle jean shorts.
So that way you're going to anticipate some measure of protractionary phase in price in London. When price rallies up, it might rally up 30 points. It might rally up 40. It might even rally 50. But you already have several pips above the 0 GMT opening price to get you in as a limit to sell. Then by having the 5-day average daily range above your entry, you're building in as much as 60 to 70 pips. And again, that's highly unlikely if you're trading on the heels of the previous day having respect of a daily premium PD array. You can, on buy days, simply buy at 0 GMT or buy it with 10 to 20 pips below the opening price at 0 GMT. There's your limit order to buy, so that way you're going to catch some Judas swing if it occurs. If it goes down a few pips and fills you, and say it goes down 30 more, the likelihood of the 5-day average daily range being subtracted from the opening price at 0 GMT and your 10 or 20 pips below that opening price as your entry, again, the likelihood is 70 pips, 60, 70 pips going down from the opening price just to have it up close. It doesn't usually happen if price is already expected a daily discount PD array. Now, you have homework. I want you to find 3 examples, and yes, you have to do this. Go through your charts and find in recent weeks where you'll have 3 examples of this concept in price action, using only the opening price at 0 GMT when you're bullish, where price rallied up, or using it as the opening price and then a limit order above or below relative to what you think in terms of the close. If it's going to be bullish or you expected to see bullish prices based on the analysis that you would see around that time, obviously you have the benefit of hindsight, but this is how you learn it. You look for it in price and you show yourself many examples. I can give you 20 of them in this, but it's not as good as if you go through the price action yourself. I'm forcing you to go through the cycle of looking for PD arrays, the higher time frame, looking at institutional order flow, and framing that on clear-cut discount or premium arrays. When price is wanting to go higher, you'll see it obviously in hindsight, but I want you to focus on the 0 GMT opening price and how much that goes down relative to the 5-day average daily range. The 5-day average daily range, if you don't have my ICT indicator, just about everybody has that, but if you don't have it, you can use the simple indicator that's on most of the platforms, the ATR, average true range. Do it on a 5-day, and that'll give you your number. Number, okay, for each day. It's going to get real close to what the ICT average daily range indicator is. The only thing that makes that one good is it gives you a line. When it hits it, it turns blue. It gives the impression that you're a lot more fancier than you really are. You don't need it, but it's just a way of building our stop loss. We'll know what our stop is based on whatever the average daily range of the last 5 days. Doesn't mean you won't get stopped out sometimes. It doesn't mean that the market won't stop you out and still go where you thought. That still can happen. But this was what my solution was to not being awake during London, but still looking for the setups based on what I understood in price. So I look forward to seeing your example shared on the forum. It'll be shared hopefully by majority of you, if not all of you. But 3 examples, do it in one post. what pair it was, where it was, how much of a movement down or up from your opening price relative to being a buyer or seller. And I want you.
We're almost gonna get to the point where we're gonna have to dissect everything. But first, we're throwing out some bullets, taking some shots. Once we kill everything, then we'll dissect it.
Who's training the new guy? 2 no-shows? What do you mean he didn't show up?
Managing with Connect Team would be a
The ICT Amplified Day Trading and Scalping.
Use the restroom. sentiment effect.
This teaching is specifically dealing with the sentiment effect. Okay, when are buying or selling probabilities the highest? Well, for day trades, as we're specifically teaching in this month, the use of the Asian range and the opening price are key. For day trades, as we're teaching in this month, the use of the Asian range and opening price are key. Bearish short days, or when you're looking to sell short, ideally you're going to be looking for a move above the opening price and or the Asian range high. When you're looking to go long on bullish days, ideally you're going to be looking to go long below the opening price and or the Asian range low. Now the market will have a short-term shift in sentiment, and less informed traders will chase price on the impulse or the initial swing intraday. This is classically known from my teaching as the Judas swing, where the market goes into a projectionary state that's opposing the general direction of the close of that particular day.
Whoa.
What's that?
I just built a budgeting app in Base 44.
Guys, Nina just built an app.
Impossible. Nina can't.
Focusing on strict conditions like daily and or 4-hour direction based on institutional order flow, and combining the PD array matrix for the next level objectives, this will provide you the highest probability setups. We wait for opposing market directions for high odds setups. Now when we're looking at order flow that's bearish on the example here in our chart, on the left hand side, if order flow from an institutional basis on a daily or 4-hour is suggested to be bearish or going lower, what we're looking for primarily is a move above the Asian range high and away from that opening price. Smart money sells above the Asian range high. When institutional order flow is bullish on the daily and or 4-hour chart, smart money buys below the Asian range low and below that opening price. Now you're probably saying to yourself, well, what is the opening price? It's going to be either ZOGM.
See, I had seen this. I had actually used this long time ago. And now I'm seeing from where it came from. This whole time, ICT, it was you. Excuse me.
GMT's opening price early in the day, if it's been a consolidation very close to that same area. In other words, if the range from the 0 GMT hour hasn't produced much of a range on the upside or downside, you can still incorporate that opening price as well. But in this teaching, we're focusing primarily on the midnight candle in New York. Conversely, when institutional order flow is bearish on the daily and or 4-hour chart, the market typically will go above the Asian range high, and that will many times suck in street money, and they will be buying above that on a breakout. When institutional order flow is bullish on the daily and or 4-hour chart, the moves that go below the The Asian range many times trip street money into selling short on the wrong side. Okay, buy conditions for a proper setup for long entries. Now what we're going to be referring to is IPTA's suggestion based on the daily or minimum on 4-hour discount array, it must be in play. In other words, on a daily chart and or 4-hour chart, price has recently respected or traded down into a discount PD array, and it's showing a willingness to support price. In other words, we had a reaction of some sort. So if we see that on a daily and 4-hour, and institutional order flow is bullish, we have a very high odds condition for a buy in.
Wisconsin's families are underwater. I'm Tom Tiffany, dam tender on the Willow Flowage for 29 years.
A day trade. There's a sufficient range in pips between market price and opposing premium array found on the daily and/or minimum 4-hour chart. What am I suggesting here? Is there enough of a range for you to profit if you want to be a buyer today based on the fact that we've traded down to a daily and/or minimum 4-hour discount array? If we have done that, the conditions are the stage is set for a potential buy or up close day. By itself, it doesn't mean much at all. But if there's a sufficient range between the current market price when you're looking to take the trade and the opposing premium array that would be found on a daily and or 4-hour chart. In other words, is it like 50, 60 pips? That's a healthy range for a day trade. Anything less than 40 pips, it's a scalp. It can be done, but I like to see 50 to 60 pips, preferably for my own tastes. Price declines under the opening price, and again, this is the midnight candle in New York, and the Asian range low. And ideally, the decline under the Asian range low will be to a logical discount array on a 15-minute time frame. Typically, price will not spend much time at the discount array on the 15-minute chart. Expect price to sharply trade higher away from the 15-minute discount array. The longer price stays or hovers near that 15-minute discount array, the odds drop off precipitously. We want to see immediate response because the banks won't keep that price level at a discount very long if it's going to be good. And short-term sentiment will be most bearish at the time when we enter our long trades. For sentiment purposes,
the decline of the Asian range low will be to a logical discount array on the $15-minute time frame. Typically, price will not spend much time at the discount array. Odds drop. Govern.
I use a 10-period Williams percent R, and I plot that. On my 15-minute time frame. As you can see in our chart here, it gives us a very clear, discernible measure of sentiment, but we don't look at the overbought, oversold conditions that this indicator usually is over referred to. The conditions really are we're looking at price primarily. And if we get a sentiment confluence, as we see here, this gives us a higher odds that we probably are going to be on the right side of the market. Marketplace.
So if you want to trade profitably, the best place to start is probably just go to this free community. Yeah, it's free, so I'm in there.
Why did price go up? As you saw throughout this week, I mentioned that we would probably see the weekly low form on Thursday's New York session. Price came down, hit the sell stops on two bases. They hit the intraday stops on the New York Open 8:30 employment number, but they did it before the numbers released. And I mentioned during the live session that day on Thursday that that's not good, and they're probably pricing in the low of the week. And it's also that sell stop discount PD array, hold low on the daily chart. And it rallies up through two fair value gaps, and it hit the gap resistance on the second uppermost fair value gap, stopping dead in its tracks there. So we had a draw on the daily chart up to a premium array in the form of two fair value gaps, pricing off of the accumulation of those sell stops with the weekly template, Thursday's low of the week forming, and we see that subsequent price move. Again, that New York session Thursday weekly low was defined before the fact. So we're seeing something in this teaching that would otherwise be looked at as hindsight cherry picking, but we watched it unfold in live conditions. Sell conditions, proper setup for short entries. Again, IPTA suggests a daily and or minimum, and it created the two subsequent that on Thursday's analysis. All throughout this week, I mentioned that we were here. This gives is, and if we get a sentiment confluence, as we see here, this gives us a higher odds that we probably are going to be on the right side of the marketplace. Why did price go up? As you saw throughout this week, I mentioned that we would probably see the weekly low form on Thursday's New York session. Price came down, hit the sell stops on two bases. They hit the intraday stops on the New York Open 8:30 employment number, but they did it before the numbers released. And I mentioned during the live session that day on Thursday that that's not good, and they're probably pricing in the low of the week. And it's also that sell stop discount PD array, hold low on the daily chart. And it rallies up through two fair value gaps, and it hit the gap resistance on the second uppermost fair value gap, stopping dead in its tracks there. So we had a draw on the daily chart up to a premium array in the form of two fair value gaps, pricing off of the accumulation of those sell stops with the weekly template, Thursday's low of the week forming, and we see that subsequent price move. Again, that New York session Thursday weekly low was defined before the fact. So we're seeing something in this teaching that would otherwise be looked at as hindsight cherry picking, but we watched it unfold in live conditions. Sell conditions, proper setup for short entries. Again, IPTA suggests a daily and or minimum 4-hour premium array is in play. There's a sufficient range in pips between the market price and opposing discount array found on the daily and or minimum 4-hour chart. price rallies above the opening price. In midnight, New York candle, and the Asian range high. Ideally, the rally above the Asian range high will be to a logical premium array on the 15-minute time frame. And typically price will not spend much time at the premium array on the 15-minute time frame. We expect price to sharply trade lower away from the 15-minute premium array. The longer price stays or hovers near the 15-minute premium array, the odds fall off precipitously. Short-term sentiment will be the most bullish at the time when we enter our short trades.
To sharply trade lower away from the 15. In this example here, using a 10-period Williams percent R for sentiment purposes, we can see at the time when the bearish order block was traded up into Asian range high, we had market sentiment most bullish, and it created the two subsequent highs of the day, and price moved lower. And this pair again is the dollar Swiss. This is in concert with our bearish idea after that gap was filled on the dollar index for this week's analysis. That's why this pair had such a significant move lower, and why this pair respected the percent R for sentiment purposes. We can see at the time when the bearish order block was traded up into Asian range high, we had market sentiment most bullish, and it created the two subsequent highs of the day, and price moved lower. And this pair again is the dollar Swiss. This is in concert with our bearish idea after that gap was filled on the dollar index for this week's analysis. That's why this pair had such a significant move lower, and why this pair respected the outlines that we're giving you here for the teachings.
Check this out. I'm going to show you how I afforded this car. Okay, you ready? All right, $118 for car insurance. That's how much I was paying. Okay, I paid.
And on its daily chart for the dollar Swiss, we traded up to a rejection block on Thursday. Friday we opened, rallied above the Asian range high, and traded down to fill in the discount array, which is in this case the fair value gap seen on the daily chart. And as you can see here, before Friday's close, the gap was filled. So when we're looking at day trades, notice that there's a specific criteria here that I like to use. Now, every day there isn't going to be a scenario that provides this as a entry. It won't give you an opportunity every single trading day, and that's the purpose. Day trading is not an everyday trading. Okay, I don't think there's any reason why every single trading day that you should be in there trying to find something, unless you're practicing and looking for concepts to being reinforced and just looking at general price action. I think you should be, aware that while that study is profitable, it doesn't equate to profitable everyday trading. Okay, so when we teach in this month the 20 pips per day session, again, that's not an enticement for you to go in every single day trying to look for 20 pips. But there are going to be conditions that I teach that help you find 20 pips, generally in something. But again, I don't want to try to build in this idea that you need to be a tradeaholic, because it's not a good, healthy lifestyle as a trader. It's all in consuming your time and your energy, and it doesn't bode well for long-term success. You end up becoming pip drunk. That's basically what I called it years ago, and I actually fell victim to that. So I don't want to give those same poor characteristics as a trader to you, or even imply that you won't be subjected to the same thing you would be if you go through that same process of trying to trade every single day. Number one, the more you trade, the more likely you're going to get a loss. The faster that next loss is going to come. And if you're trying to trade every single day, chances are you're probably going to build a false sense of your ability. And the worst thing that can happen is you get a series of good strings of wins, and it makes you think that you're way better than you really are. And the market has a tendency to go into a dry spell. And what you might think is in the charts today may not be there tomorrow or the day after. So what we're looking for, as outlined in this specific teaching, using sentiment and a rule-based idea about the Asian range, this helps us ferret out the better trades. We won't get this condition every single trading day, but the days that we do, those are the days that this highest probability for day trading are going to be in your favor. Until the next lesson, I wish you good luck and good trading.
Auto insurance all seems the same until it's time to use it. With USAA, it's easy to file claims, schedule repairs, and
Welcome back, folks. This is lesson 2 of the May 2017 ICT mentorship, ICT Amplified Day Trading and Scalping. This teaching is going to be teaching filling the numbers. Okay, when we talk about filling the numbers, what we're talking about is the likelihood or the tendency for IPTA to fill specifically 4 numbers per day. Now, the daily range will seek to fill or trade to 4 specific levels each trading day. These 2 levels that first come to mind is the previous day's high and low. As a day trader, you're going to work with the previous day's highs and lows and the last 3 days high and low, whichever the highest is in that regard, for swing points based on a daily chart. Those reference points are going to be like your bread and butter. You're going to go to these specific levels because it's going to give you a great deal of context, as you'll learn later in these months' teachings. But the previous day's high and low, we always look for one of those levels to be traded to. It doesn't have to happen because the daily range could be smaller than would be required to get to the previous day's high or low. But generally, we're looking for a retest or trade through previous day's highs and lows as a day trader. And for one of the tools that's most used by retail traders and still large funds, they will use what we understand as historically the floor traders' pivot numbers. Now, I don't use them a great deal in my trading except for this. I look for the central pivot point, and these are 0 GMT pivots. We look for the movement above the central pivot in the form of M3, which is the midpoint or 50% of the distance between the central pivot point and R1. R1 or resist. resistance level for staged or
314, 314, 253, 253, midpoint, 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 midpoint. CPP, neutral pivot point, and
orders. M4, which is the midpoint or 50% of the distance between R1 and R2 pivot point. R2, which is the resistance level for staged orders. M5, midpoint or 50% of the distance between R2 and R3. And R3, which is the resistance level for staged orders. Now you're probably asking yourself, what are staged orders, Michael? What is this? Because traders most likely will be using pivot points collectively, and funds use them as well, IPTA will invariably trade to them and through them. Most of the time, folks that use pivot points aren't really using them accurately, and they don't always work either. But there's a tendency for IPTA to want to trade to them because there's going to be staged orders there. Staged means there are buyers and sellers at those levels because most people don't know how to use them. So what would be otherwise viewed as a good buy point below the central pivot point at like S1 and S2, that actually might be a really good area to sell short once the daily ranges start to expand down and it trades back up to that S1 or S2. That could be a continuation sell. But if you look at the general consensus across the board in retail perspective, they think anything below the central pivot point is a good buy. So that's why we talk about it in terms of staged orders. We don't care whether they're buying or selling. We just know that IPTA is going to go there to facilitate trade and go through that market for fund liquidity, not retail broker traders, not the little guys that's, in the mom and pop brokerage firms. On the big bank level, they'll trade through these levels to fill those numbers.
Thinking about a degree in cybersecurity? Don't sleep on this. UMGC is waiving their application fee through June 1st, so now's the time to apply. Low-cost tuition, 100% online classes, and you can gain the skills to become an ethical hacker. UMGC.
And then obviously below the central pivot, we look for M2, which is the midpoint or 50% of the distance between central pivot, and S1. S1 is the first support level for staged orders. Then M1, which is the midpoint or 50% of the distance between S1 and S2 pivot points. S2, which is support level for staged orders. M0, which is the midpoint or 50% of the distance between S2 and S3. And finally S3, which is the support level for staged orders. Now you're probably, if you've never heard of a pivot point or if you've never seen these before, this is probably very confusing for you. And it's not that big of a deal. It's a simple little indicator that I'm going to share with you on the forum. So at the time of this teaching, when you're done watching it, all you have to do is go back to the forum under the resources tab. Underneath the PDF file link that's not active until all the lessons are done, you're going to see a link there where you can download the MT4 indicator. While it's not important that we understand how to trade pivot points like the retail crowd, it's important to understand what these levels are and how we are going to interpret them in terms of filling the numbers. Using the order flow direction and PD array matrix for specific bias, we can use these numbers to help determine what numbers we'll be filling for that particular day. The trade entry point you use for your trades, you look for the numbers that will fill from that price point. If you're going long, from your long entry, you look above your entry point for the sequential 4 levels above. If you're selling short, you look below your entry point for the sequential 4 levels below. That means if we're looking to go short and we happen to be entering near the R2 level, we could look for M4, R1, M3, central pivot, 4 levels below us. That would be an example of looking for the numbers to fill using the pivots. On large range days, more than 4 levels can be filled or traded to. The tendency to move at least to 4 levels is a general rule of thumb. Ideally, the majority of your trade position will be taken off after 4 levels are filled. Always leave a portion on for the potential for a large range day if time permits it. So if we're looking at a position we're long in intraday, say we've gone long from London and we've already seen 4 pivots traded to on the upside, the bulk of your position, I'd say about 75 to 80% of your trade, should have been taken off in terms of profit, and leave a small portion, 25 to 30%, remaining to see if you get a much larger range day, because New York can see a much wilder condition where it continues, and you may have already seen 4 levels traded to just inside of the London session.
Imagine being able to build an app with your name on it, just by thinking about it. Meet Base 44, a complete AI.
See if you get a much larger range day, because New York can see a much wilder condition where it continues, and you may have already seen 4 levels traded to just inside of the London session. Using the order flow direction and PD array matrix for specific bias, utilizing the central bank dealers range when you are shorting the market, selling above the central bank dealers range, you count the low of the central bank dealers range itself as a level, or that's level 1 of 4 to fill. In other words, once we determine what the central bank dealers range is, whatever its lowest line or the range that creates the base of that consolidation or range, whatever that lowest figure is, whether you're using the wicks low or the lowest close or open for the bodies, whichever that is, that represents the first of 4. So you would count that as 1. So you'd be ideally shorting above that low. So when price trades down in your favor when you're short, when you cross over the central bank dealer's range low, that counts as 1 of 4. We expect the market to trade down to 4 central bank dealers range lows. And let's look. Look at the chart and see an example. And everything we're showing here, you would just reverse for buying. So going short here, this would be level 1 because you're selling short above the central bank dealer's range low. So when price trades down through it, that's counting level number 1, level 2, level 3, and finally level 4. So there's an example of IPTA filling the numbers on the basis of the central bank dealer's range. So now look what we've done here. I've given you a means of looking for how the daily range is fulfilled using pivot points. Now with the central bank dealer's range, which is unique to me, no one else does this, but everyone knows about pivot points. But central bank dealer's range, we look for that same phenomenon. We're looking to sell short above the central bank dealer's range low, and using the central bank dealer's range low as your level 1, and you count down each new standard deviation of the central bank dealer's range projected lower. Every time you cross the low end of that new range projection or standard deviation, that's counted as 1 new level, and you look for 4 of those to fill. Reversing this, you'd be buying below the central bank dealer's range low, and once we get to the central bank dealer's range high, that would be counted as level 1.
Forget the dubious investment tips. With IG, you can enjoy up-to-date insights, analysis, and tools. IG. Trade, invest, progress.
Hello.
Hey, you want to play with me?
Sure. You want me to help you with your groceries?
This journey will...
And you would continuously do the standard deviations of the central bank dealer's range, projecting it higher, 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 stacking it on top of each other. And once you get through 4 of the central bank dealer's range highs, that's your level 4 count, or the numbers being filled on the basis of the central bank dealer's range. So IPTA will look to fill 4 pivots in your day. It'll look to fill 4 central bank dealer's range projections or standard deviations. Either or can be used. Now, I already know what you're thinking, but trust me, I'll answer that question. I already know what you're thinking, trust me. We'll get to it at the end of this teaching. Using the order flow direction and PD array matrix for specific bias. Utilizing the Asian range, when you're buying the market, buying below the Asian range, you count the high of the Asian range as level 1 of 4 to fill. Expect the market to trade up 4 Asian range highs, see chart to the left, and everything I'm showing you here, you're going to reverse for shorting.
Damn, what the fuck? Did I break my fucking Google? I broke Google Docs, man. I will be back again.
more money in your pockets, safer communities here in Wisconsin, and government that works for working people. Check out my website to learn more about what we're doing for you in Washington. Paid for by official funds authorized by the House of Representatives.
Hey, can you break this down for me?
The first step for using the quadratic formula is to calculate the discriminant.
Oh.
So today I'm going to show you the timing set added.
Okay, you see the market making a low here after midnight candles opening, trades lower. Aging range high fill, number 1 level.
Let me make a phone call real quick.
you.